Hey everyone, welcome back. Today we're diving into a major announcement that could directly impact millions of people across the UK. The HMRC has officially confirmed a significant change to its tax and banking system that will come into effect on the 15th of November, 2025. This isn't just a minor tweak. This update could have real consequences for pensioners, savers, and anyone who receives regular payments from the Department for Work and Pensions, or DWP. In this video, we'll break everything down: what this change means, who will feel the impact the most, how it connects to your state pension and savings, and most importantly, what practical steps you need to take before the deadline hits. According to HMRC, the purpose of this update is to modernize the way income data is reported and ensure tax collection is more accurate than ever. However, financial experts are already raising concerns that this new system could lead to unintended issues. These might include unexpected tax deductions, automatic account reviews, or even delayed pension payments if your financial information isn't completely up to date. So, it's critical to understand what's coming and how to prepare. Today, we'll explore the HMRC's new digital data sharing framework, explain how your bank will now communicate with HMRC in real time, and give you clear steps to stay safe, compliant, and avoid any unpleasant surprises. So what exactly is changing starting from November 2025? Beginning on the 15th of November, HMRC will roll out a digital reporting system across all major UK banks, building societies, and other financial institutions. Under this system, banks and providers will begin sharing financial data directly with HMRC on a real-time basis. This includes interest earned, regular deposits, large or unusual transactions, and even overseas transfers. The overarching goal is to close gaps in tax reporting and prevent underreporting of income from sources like savings, investments, pensions, self-employment, and other income streams. This new level of transparency is expected to have a direct effect on ordinary citizens. Even small discrepancies, such as unreported savings interest, could automatically trigger a tax code review or adjustments without any manual intervention. Essentially, your bank will now be communicating with HMRC in real time, sometimes even before you submit your self-assessment return. For many, this could mean smoother and more accurate tax reporting, but for others, it could lead to temporary delays or corrections that may feel sudden or confusing. Why is HMRC implementing this change now? The agency says the new system is part of a broader initiative to tackle tax evasion and misreported income in an increasingly digital economy. The UK reportedly loses around £35 billion each year due to errors, undeclared income, and tax avoidance. With more people earning money online, through investments or digital banking platforms, HMRC wants a tighter grip on income flows. By linking bank data directly to individual tax records, HMRC can immediately spot irregularities, automatically adjust tax codes, and flag potential overpayments and DWP-related benefits. While the government frames this move as modernization, it also comes at a time of heightened financial scrutiny. The pressure to increase revenue and manage public spending after years of high expenditure means the government is closing every gap it can. In practice, your personal financial data is now part of that process, making it essential to ensure everything is accurate and up to date. Who will feel the impact the most? In short, this affects nearly anyone with a UK bank account, but certain groups may notice the changes more immediately. Pensioners with multiple income streams, from state, private, and workplace pensions, will need to be especially vigilant. Self-employed individuals or freelancers earning via digital platforms or gig work could see automatic adjustments to their tax codes. Savers with multiple accounts or taxable interest could be flagged for discrepancies. Those receiving overseas income from property or family support may also be affected, and benefit claimants could see DWP payments verified against HMRC data, potentially prompting temporary pauses or recalculations. For pensioners, even minor differences in reported income or savings could trigger automatic tax recalculations or benefit reviews, making it crucial to check that all records align across HMRC, DWP, and pension providers. So, what will banks actually have to do? From mid-November 2025, banks will connect to HMRC's Digital Data Gateway, reporting financial activity automatically. Transactions of £1,000 or more could be flagged for verification. Regular payments, including rental income or overseas transfers, will be reported monthly. Savings interest will now be reported in real time rather than annually. This real-time synchronization ensures your tax records and bank statements match, leaving much less room for reporting errors. For example, if your savings account earns £450 in interest, HMRC will already be aware, and your tax code could be adjusted without you lifting a finger. The link between HMRC and DWP is also critical. With this coordination, pension payments, pension credit, and other benefits can be cross-checked against your financial records. If your data shows savings above certain thresholds, such as the £10,000 pension credit limit, payments could be paused or adjusted automatically until a review is conducted. While this automation is designed to reduce fraud and overpayments, it could also inadvertently delay payments for those whose records are accurate but slightly mismatched. Regularly checking your government gateway account and ensuring your details are correct across all platforms is now more important than ever. A new feature called the £300 automatic deduction rule adds another layer to this system. In specific cases, HMRC will recover small tax debts or benefit overpayments directly from linked accounts before sending a formal notice. This is part of HMRC's real-time adjustment framework, designed to automatically fix minor discrepancies. Although this isn't common, it underscores the importance of reviewing your HMRC communications carefully, particularly in November, and acting promptly if anything seems off. How can you prepare before the 15th of November? Start by logging into your HMRC personal tax account and double-checking all your savings and pension information. Make sure your DWP and pension provider records match HMRC's details. Review your tax code for the 2025-26 year, and if you have multiple income sources or accounts, consider consulting a tax professional. Preparing now can prevent unnecessary deductions or delayed payments once the system goes live. For savers and investors, the change also has implications. From November onwards, all interest from savings accounts, ISAs, premium bonds, and fixed deposits will be automatically reported. While ISAs remain tax-free, incorrectly labeled accounts could trigger accidental reporting errors. Retirees who rely on savings interest should ensure each account is correctly categorized to avoid unnecessary deductions or complications. Ignoring this update could have consequences. Unverified or outdated records could lead to unexpected tax adjustments, delayed DWP or pension payments, temporary account flags, or even penalty notices. Even minor errors such as outdated postcodes or incorrect account numbers could trigger problems under this automated system. Experts believe this is just the first phase of a broader digital transformation. By 2026, HMRC may expand real-time reporting to include rental income, self-employment earnings, and even cryptocurrency transactions. The long-term vision is a fully digital tax environment, automatically tracking and assessing all income. While this could increase efficiency, it also raises questions about privacy and accessibility, especially for older or low-income households. November's update is only the beginning of this new era in tax and benefits management. In summary, the HMRC rule change taking effect on the 15th of November 2025 is one of the most significant shifts in the UK tax system in decades. Banks, pensions, and tax records will now communicate directly and automatically. While this could simplify tax reporting for many, it may also result in unexpected deductions or account reviews for others. The key takeaway is to verify your records, ensure everything is accurate, and stay informed as the rollout begins. If you found this explanation helpful, make sure to subscribe and give this video a like so that more pensioners and taxpayers can stay up to date and financially prepared.